Hello students. Now in this video I'll be explaining on one of the derivative forms, that is rights and warrants. With this we'll be winding up the main bifurcation derivatives, right? So now what is warrants is all about, we shall understand about that. See, a warrant, basically it is an option, to purchase a specified number of shares, at a specified period during or at the expiry of a specified, the period. So what this warrant gives for the holder, a warrant is something, holder is a buyer, right? So the warrant, it gives the buyer, the right to purchase from the company. What to purchase? A specified number of shares, out of so many shares, which is available in the company, a fraction or a portion of shares is being, given as a right for the holder to purchase from the company, and a fixed number of shares in the future at obviously a predetermined price. So here what happens, see, the holder of the warrant, he may be allowed, to transfer or sell his right in the secondary market, right? Or in order to keep the right as an investment also. Here, the holder of a warrant can choose whether or not to exercise the option, that is upon, the exercising the option. And like warrants, they are not a major source of funds. Their features or the characteristics, it may help the company to attain the desired capital structure, that's it. And warrants, they are generally issued with the other securities like preference shares or with a bond. Fine. So the warrants, they may be attached to a debt issue, to work as a, sweetener and to add to the marketability of the issue. And now what does a warrant contain? A warrant contains, the number of shares that can be purchased per warrant. Fine. And the price at which, the warrant can be exercised, and what's the expiry date, with respect to the warrant. Here, just like, the equity shareholders and the preference shareholders, debenture holders, you have warrant holders, where these holders, who hold the warrants, they do not have, they are not entitled to any of the dividends, nor do they have any kind of the voting a power as well. See, somewhere here you have a topic of convertible security. With that, I'll give a connection with the warrant, right? What is convertible security now? See, a bond or a preferred stock, the preference share capital, it is convertible into a specified number of shares, of common stock at the option of the holder. Holder is nothing but a buyer, right? So here, a convertible security, it requires the surrender of the security, that is in exchange for the equity shares. And this, it provides the convertible holder a fixed return. It can be in form of interest, or it can be in form of a dividend. And the option to exchange a bond or preferred stock for the common stock is absolute. And the option, it allows the company to sell the convertible securities, at a lower yield than it would have to pay on the straight bond or the preferred stock issue. So now, relating with that, warrant, what does it state? See, since it is under the derivatives, of course, it is relatively long-term option in order to purchase the common stock, at a specified strike or the exercise price, that is over a specific period of time. On the other hand, a warrant, it requires a surrender of the warrant plus the payment of additional cash, which is called as option price, or it is also called as exercise price, that is in order to obtain the equity shares. So basically the warrants, they are issued by a company to the investors, who may exercise them in order to buy the shares, or may resell them to other investors as well. Whereas a convertible security, it issues a kind of, it gives the holder or the buyer, the right to receive the equity shares through the exchange of the convertible, that is for the equity shares. And the warrant entities, where the entities where which goes ahead with the warrants, they entitle the security holder, that is in order to purchase the equity share at a specified price. And that's really very important. And here, like both the securities, that is convertible plus the rights and warrants, it provides the purchaser, with the opportunity for a speculative gain. Now what is speculation? Speculation is, all about trading, that is buying and selling of the financial instruments, where the element of risk, that is the degree, the level of risk is more high under this. And if the company is successful, and the market price of the equity share will also increase over here. And if the warrant, if it is converted, then the capital structure is always, shifted to a relatively, lower leverage position, because here, new equity capital is issued without any change in the debts. And if convertible securities are converted, then the reduction in leverage would be more pronounced, because new equity share, would be issued with a reduction in debt, right? So what you have to understand by this nerve is that, see, the purpose, whatever you take up, there should be some agenda, the objective, the purpose out of that particular investment. See, the purpose of this particular, that is the warrant derivative, is that it may be, to make a debt issue or a preference capital or issue attractive, whereas the right has an objective of, raising the fresh funds, as well as to maintain, the shareholding of the existing shareholders. It matters a lot. And the share right is, it is generally exercised in a short period of 1 month, it can be in terms of 1 month or so, whereas warrants are generally convertible after a year or so. That's the reason why it is segregated under derivatives, right? So here, the right shares, they are generally issued at a price which is lower than the prevailing market, whatever the spot price which will be there in the market price. The right shares, they'll be, issued at a price lower than the prevailing market, whereas the conversion price of the warrants, it may, kept the slightly high than the current price which is available. So that's how the things are going to work over here. Then apart from that, to understand with the features, how the warrants are going to work, what are the characteristics associated with that. See, warrants are, they are basically issued by, attaching them to the other securities, as I said, right? Then warrants, it can be traded as a separate instrument as well, if you don't want to go for, attaching them in the other securities. And the next step is, the number of equity shares that can be purchased is also fixed under the concept of warrants. And the exercise price, the strike price, it is also fixed. And the warrants, carry no voting rights, just like preference shareholders. Here the warrant holders also, they do not carry any of the, voting rights. And they are not entitled to receive the dividend or interest payment, right? So there is something like how you are going to value. So the value of warrant, it equals the difference between the market price of the equity shares which is purchased through warrants. This is what I told, a couple of minutes back. Warrants are something which are issued by attaching them to the other securities. So here, the difference between the market price of the equity shares which is purchased through warrants and the total option price paid for these shares to the company is going to matter. And here, the market value of the warrant depends upon many factors, right? What should be the value, market value on warrants? One is the share price. See, a higher share price, it will increase the value of a warrant, isn't it? Whereas offer price, a higher offer price, what it does, it will mean a lower value for the warrant, as the warrant, the holder must pay more for the shares purchase. That's the reason. And you have something called as, underlying a risk. Now what does underlying a risk talk about? See here, the total risk of the volatility, about the share price, it also affects the market value of the warrant. And apart from that, you have something called as a time to expiry. Of course, whatever the investment you take, there should be a maturity period, there should be an expiration date. Here, the longer the time to expiry, the higher would be the value of the warrant. That's how the things are going to work under the warrant. So to sum up with this particular concept, basically warrants are the securities that gives the holders the right but not the obligation. Whereas to buy the share of common stock directly from a company, at fixed price for a given period of time, each warrant specifies the number of shares of the stock and that the holder can buy, whereas the exercise price and the expiration date will be considered. Whereas warrants are also known as equity kickers, because they are usually issued in the combination with the privately placed bonds, and sometimes warrants can also be like detachable. Namely, you have debt warrants, you have harmless warrants, where variant of debt warrants you have it warrant not exercisable until the host bond becomes a callable. You have a covered warrants, you have put warrants, asset warrants, right? So what are the things you have to keep it with respect to warrant? The expiry date of that warrant, exercise style, how it has happened on a specific date, or the price, right? And deliverable, or whether a cash settlement is involved, whether it is a call a warrant or a put warrant, that is to buy option or put option. What's the conversion ratio, that is where you can deal with the warrants in terms of other financial, you can go through with the other financial instruments, that is in terms of preferred stock also we can go ahead, and you will have to take care of the what is the underlying asset that is attached with that particular thing. So time frame, conversion, and what will be the further investment period, it plays a very very vital role under warrants. All right, so this is all about the concept of the warrants under derivatives.